$1,000 is too small to matter. That is the sentence most first-time investors tell themselves, and it is the reason many of them never begin. It sounds like humility. It is actually a math error. That same $1,000, left in a broad U.S. stock index and never touched, has historically grown to roughly $17,000 over 30 years at the market's long-run average return of about 10% before inflation. One deposit, no further contributions, 17 times its size. The figure is not exotic. It is the plain output of compounding applied to a number people dismiss as pocket change. So the belief collapses on contact with arithmetic. The 1,000 is not too small. It is the seed of the entire thing. And yet, here is the fracture this documentary exists to examine. Most people who actually start with $1,000 do not end up with $17,000. They end up back at zero, or close to it, not decades later, within about 2 years. That gap is the whole story. Consider the shape of it. A person finally opens an account, they fund it with $1,000 they scrape together. They buy something. For a few months, the balance drifts up, and it feels like proof they were right to start. Then the market does what markets do. It drops 15–20% over a few weeks, and the 1,000 becomes 800, then 780. And the person, watching real money evaporate in real time, does the thing that feels like safety. They sell. They pull what is left. They conclude that investing is a rigged casino, and that they were foolish to try. The money goes back into a checking account, where inflation quietly eats it, and the 30-year compounding curve never gets to exist. Notice what did not happen in that sequence. The person did not lose because they picked the wrong stock. They did not lose to a scam, or to bad luck, or to a fee they never saw. The investment they chose was, in most versions of this story, perfectly adequate. The failure happened somewhere else entirely, in the order in which they did things, and in what they had not built before the drop arrived. That is the claim this series will defend, block by block, with numbers on screen each time. The reason first-time investors stall is not a shortage of money. It is not a shortage of information. The information has never been more free or more abundant. It is an ordering problem. People attempt step 4 before they have cleared step 2. They buy before they have built the thing that lets them hold. And a portfolio assembled out of order does not fail loudly. It leaks value quietly, at one predictable point, until the investor walks away convinced the system was the problem. The $1,000, understood correctly, is not a purchase. It is a sequence. The ticker matters far less than the order. And there is exactly one step in that sequence where nearly everyone who fails the same step, arriving at the same moment, for reasons documented across every major market decline of the past century. By the end of this, that step will be named, and the defense against it built piece by piece, until $1,000 can survive a real crash without the person holding it flinching. Because the failure, when it comes, has almost nothing to do with which investment they picked. So which step, exactly, ends most beginners' investing careers? Not the buy, not the research. The answer is almost boring, and that is precisely why it works, because nobody defends against a threat they think is beneath them. Consider a composite case, the kind that repeats across brokerage data every year. Call her the archetype. A 34-year-old in Denver, salaried, cautious, no debt. She loses sleep over. She spends 8 months reading before she moves a dollar. She compares brokers. She reads about expense ratios until the term stops feeling foreign. She picks a broad index fund, a genuinely good choice, the same one a fee-only advisor would likely have handed her. She funds the account with $1,000. By every measure that gets discussed on personal finance forums, she did it right. Then March arrives, or some month like it, and the index falls 18% in 5 weeks. Watch the sequence, because it is the whole lesson. Her 1,000 becomes 820. Nothing she read prepared her for what that feels like at 11 at night, refreshing the balance. The fund did not fail. Her research did not fail. What fails is the 11 o'clock feeling. The certainty that the number will keep falling, that holding is stubbornness, that selling is prudence. She sells at 810. She feels relief for about a week. Then the index recovers over the following months, climbs past where she bought, and keeps going without her. She did everything right, except the one thing nobody sells a course on: staying. Here is the lesson underneath the story. The entire process of investing a first $1,000 is a sequence of steps, and almost every step can be researched, optimized, and executed by a beginner alone. The account type, the fund, the fee, the contribution. Those are solvable with an afternoon and a spreadsheet. But the sequence has one step that cannot be solved with information, because it is not an information problem. It is the step that arrives after the first real drawdown, the moment the system asks the investor to do nothing while their money visibly shrinks. That is the step. Not the first purchase, the first holding through a loss. It is worth being precise about why this point is so lethal. Every step before it is a decision made in calm, at a desk, with coffee, with time to compare. The holding step is a decision made in fear, in real time, with real money moving the wrong direction. The beginner has trained for every part of the process except the only part that decides the outcome. They have optimized the easy steps and walked unarmed into the hard one. Brokerage behavior studies have measured this for decades. The average investor underperforms the very funds they own, not by a little, because they buy after gains and sell after losses, doing the opposite of the discipline the fund was built to reward. The gap between what the fund returns and what its owners actually earn has a name in the research, and it exists almost entirely because of that single behavioral step. The step that quietly ends most beginners' investing careers is not choosing wrong. It is selling when a good choice temporarily looks like a bad one. Naming it this early is a promise. Everything that follows, the buffer, the account, the cost floor, the automation, the written rule, exists to build the person who can stand at that exact moment and not move. But naming the failure is not diffusing it. Before that step can be survived, the ground beneath it has to be laid, brick by brick, in the right order. And the order starts well before the $1,000 is ever spent. The most common objection to what comes next sounds responsible, which is why it's dangerous. It goes like this: waiting to invest is just an excuse. Markets compound. Every month spent building some buffer first is a month of growth surrendered. Start now, start small, and figure out the safety net later, because the real risk is delay, not exposure. Take that argument at its strongest, because it isn't foolish. The arithmetic behind it is real. $1,000 deposited today, rather than 9 months from now, does capture 9 extra months of compounding. And over 30 years, those months are not free. There are people whose emergency fund never quite gets finished, who keep it as a permanent excuse, and who die with cash rotting in a savings account that never earned a thing. For them, the objection is correct. Perpetual preparation is its own kind of failure. Waiting can absolutely be cowardice wearing the mask of prudence. And yet the argument breaks on a mechanism, not a mood. Here is how the mechanism works. Investing without a buffer doesn't just add risk. It changes what the investment is for. Money in a broad index is money you have agreed not to touch for years, because touching it during a decline is the exact behavioral failure that ends most beginners. But life does not schedule its emergencies around market conditions. The car transmission fails, the tooth cracks, the hours get cut. When that bill arrives and there is no cash reserve, the only place to reach is the brokerage account. And it will, with statistical reliability, be reached during a downturn, because downturns and personal financial stress tend to arrive together. A recession that cuts your hours is the same recession that cuts your portfolio. So the person without a buffer is not an investor who might sell in fear. They are an investor who will be forced to sell on the market's worst terms by a plumbing bill. The buffer isn't caution competing with growth. It's the thing that lets the growth survive contact with reality. The same logic disarms high-interest debt, only faster. A credit card charging 22% is a guaranteed negative return of 22% a year. The stock market's long-run average is about 10%, and unlike the card, it is not guaranteed. Investing $1,000 while carrying a $1,000 card balance is borrowing at 22 to earn a hoped-for 10. The math is not close. Clearing that debt is not a detour before investing. It is the single highest return investment available to that person, and no fund on earth reliably beats it. This is why the order is not negotiable. The buffer and the debt are not warm-up exercises. They are the load-bearing walls. Skip them, and the portfolio still gets built. It just gets built on ground that collapses the first time life pushes on it, which returns us to the failure already named. The person who sells at the bottom is very often the person who had no choice, because the buffer that would have let them hold was never there. The practical shape is plain. First, a cash reserve large enough to absorb an ordinary emergency without touching invested money. For most beginners, a few $1,000s held somewhere boring and instant, not a precise ritual but a real floor. Second, no balance sitting at double-digit interest. Only then does the $1,000 become seed rather than hostage. Assume that ground is now laid. The buffer exists. The high-interest debt is gone. The $1,000 is finally free to be invested rather than borrowed against. The very next decision looks trivial and is not. Before a single fund is chosen, one hidden choice determines whether the government quietly helps every dollar grow or taxes it on the way up and again on the way down. A beginner opens two identical portfolios, same $1,000, same broad index fund, same automatic contribution, same everything a personal finance forum would tell them to compare. And 30 years later, one of them has thousands of dollars more than the other, for reasons that have nothing to do with the fund and everything to do with a checkbox they clicked in the first 10 minutes and never thought about again. The checkbox is the account type, and it is the most underweighted decision in beginner investing because it feels like paperwork and behaves like a fee. Set the two scenarios side by side. In the first, the archetypal beginner funds an ordinary taxable brokerage account. Nothing wrong with it. The money goes in, buys the index, grows. But every year the fund pays dividends, and those dividends are taxed in the year they arrive, whether or not the investor sold anything. And decades later, when the money is finally withdrawn, the growth is taxed again as a capital gain. The government takes a slice on the way up, in small annual bites, and a larger slice at the exit. In the second scenario, the same beginner puts the same $1,000 into a Roth IRA. The mechanics of the investment are bite for bite identical. Same fund, same market, same drawdowns. But inside the Roth, the dividends compound untaxed year after year, and when the money comes out in retirement, it comes out entirely tax-free. No annual bite, no exit slice. The difference is not the investment. The difference is the container the investment sits in. Here is the central truth this block exists to install. For a first-time investor, choosing the account is a larger decision than choosing the fund, because the fund can be swapped later at almost no cost. But years of tax drag inside the wrong account cannot be refunded. The order of operations reappears exactly where the last block left it. Buffer first, debt cleared, and then, before a single ticker is selected, the account. Let the difference unfold in plain arithmetic. Take that $1,000 growing at roughly 10% for 30 years, landing near $17,000. In the taxable account, annual taxation on dividends shaves the compounding slightly every year, and the final withdrawal is taxed on top of that. Depending on the investor's bracket, the after-tax result can run meaningfully lower than the tax-free figure the Roth delivers. On $1,000, the dollar gap sounds modest. Scale the same habit to the automatic contributions coming in later blocks, and the account choice quietly decides a five-figure difference over a working life, earned by the same fund, in the same market, held for the same length of time. There is a further unfolding most beginners miss. The Roth has a second, quieter function that matters precisely for the failure already named. Contributions to a Roth, the money actually deposited, not the growth, can generally be withdrawn without penalty, which means the account chosen for tax efficiency doubles, at the edges, as one more layer between the investor and the panic sale. It does not replace the cash buffer built earlier, but it means the invested dollars are not quite the hostages a taxable account can make them feel like. So the sequence now has an answer to the question this act opened with: what has to be true before a single dollar is invested? Three things, in order. A cash reserve that absorbs an ordinary emergency, no balance bleeding at double-digit interest, and an account chosen so that time and the tax code work with the money rather than against it. Clear those. in that order, and the ground is finally load-bearing. Skip anyone, and the portfolio gets built on a floor that tilts. The prerequisites are done, the buffer exists, the debt is gone, the account is open, and the right kind. For the first time in this entire process, the $1,000 is genuinely free, not borrowed against, not tax exposed, not waiting on anything. Which means it now needs something to buy, and the moment the beginner reaches for a fund, a new adversary appears, one that does its damage in fractions of a percent, so small it's easy to ignore, and so persistent it can outlast the investor themselves. 1%. That is the number a beginner is told not to worry about. The advisory fee, the expense ratio, the small charge that sounds like a rounding error against a portfolio that hasn't even been built yet. 1% of $1,000 is $10 a year, $10. It is genuinely hard to feel threatened by $10. Which is exactly what the number hides. A fee is not a one-time subtraction. It is a percentage taken every year, forever, on the entire balance, and the balance is the thing that is supposed to be compounding. So the fee does not just take $10 this year. It takes a slice of everything those $10 would have become over the next 3 decades. The charge is small. What the charge removes is not. Watch the recalculation, because this is where the harmless number turns. Take the $1,000 from the first block, growing at the market's long-run average of roughly 10% for 30 years, landing near $17,000. Now run the identical scenario with 1% skimmed off every year, the same fund, the same market, the same 30 years, minus a single percentage point of annual return. The growth rate drops from 10% to 9%. It sounds like almost nothing. The ending balance is not near $17,000. It is closer to $13,000. $4,000. On an account that started with $1,000. Gone, not to a crash, not to a bad pick, but to a fee small enough that the investor never once thought about canceling it. That is the mechanism the 1% number conceals. The fee compounds against the investor at the same speed the market compounds for them. Every dollar the fee removes is a dollar that would have grown, and the dollars it would have grown into would themselves have grown. Over 30 years, the drag doesn't add up. It multiplies. And it multiplies most cruelly on the smallest accounts, because the beginner with $1,000 has the least margin to spare and is the most likely to be told the fee is too small to matter. Set the contrast plainly. A broad index fund available to any beginner today carries an expense ratio in the neighborhood of 3 to 0.05%. $3 to $5 a year on that $1,000, and falling. A 1% advisory fee is roughly 20 to 30 times larger, charged on the same balance, doing the same compounding damage in reverse. The fund the advisor recommends may be perfectly good. The fee wrapped around it is the leak. And here is where the fee connects back to the failure this series is built around. The 1% charge does not announce itself. There is no drawdown, no 11 o'clock feeling, no visible loss to react to. It is subtracted quietly, in a line the investor rarely reads, in a month when nothing appears to go wrong. The panic sale destroys a portfolio in an afternoon. The fee destroys one over 30 years. So gradually that no one is ever standing at the moment it happens. Both end in the same place. One is loud. The other is silent, and the silent one is harder to defend against precisely because it never triggers the alarm. So the cost floor is not a detail to optimize after the fund is chosen. It is a constraint set before it. The question is not which fund performs best, a question no one can answer in advance. The question is, which fund costs almost nothing to own? A question that has a clear, checkable answer today. Lower the cost floor to the ground, and one of the largest lifetime drains on a small account simply disappears. Something quietly important follows from that. Once the cost floor is set to near zero, the choice of what to actually buy stops being the high-stakes research project beginners fear. It collapses to almost nothing. 40 tabs open. Comparison charts. A spreadsheet of tickers ranked by last year's return. This is what most beginners think the buy is supposed to look like. A research project, a test they might fail, the moment their whole $1,000 rides on picking the right winner from thousands of candidates. And it is the reason so many of them never press the button at all. The decision feels too large to get wrong. It isn't. Not once the cost floor from the last block is set to the ground. The moment the fee is near zero, the entire research project collapses, because the thing that was supposed to justify all that comparing, the search for the fund that will out-return the others, is a search with no reliable answer. Nobody can tell in advance which sector, which region, which handful of stocks will lead the next decade. The beginner ranking funds by last year's performance is ranking them by the one number that predicts almost nothing about next year's. So the mechanism that solves this is not a better prediction, it is the refusal to predict at all. Consider what a broad index fund actually does. It does not choose. It buys a sliver of every meaningful public company in its universe. A total US market fund holds thousands of them at once, in proportion to their size. The investor is not betting on a company. They are buying the entire market's output and letting the winners inside it do their work automatically. When one company fails, it shrinks out of the fund on its own. When another grows into a giant, it grows inside the fund without the investor lifting a finger. The selection problem the beginner was terrified of has been solved structurally by the design of the instrument, rather than by their skill. That is why the single broad index default substitutes for research. It is not a shortcut around doing the work. It is the recognition that the work of picking winners reliably loses. Diversification this wide converts the impossible question, which stock, into a question that no longer needs an answer. Watch the archetype reach the moment. The Denver 34-year-old from earlier, buffer built, high-interest debt gone, Roth open, the near-zero cost fund identified. Everything that came before was a decision made in calm, and this one is too. She does not agonize over 40 tickers. She types the symbol of one total market index fund. She enters $1,000. She confirms. The account shows shares where cash used to be. That is the buy. The thing 8 months of reading was building toward. It is, mechanically, almost nothing. Here is how a beginner applies it without a single further judgment call. One fund, broad enough to hold the whole market, cheap enough that the cost floor is already handled. Not 40 funds layered on top of each other, which mostly rebuy the same companies and add expense without adding diversification. Not a satisfying-looking mix of 5-sector bets, which is stock picking wearing a costume. One broad fund is not the beginner version of a real portfolio that gets upgraded later. For the vast majority of investors, at every account size, it is the whole answer. The simplicity is not a compromise, it is the point. And now the sequence has closed its loop on the earlier question, the one asking which step quietly ends most beginners' investing careers. It is not this one. The buy took 90 seconds and required no expertise the beginner didn't already have. Every step of assembling this portfolio, from the buffer to the account to the fund, turns out to be solvable at a desk, in calm, with an afternoon. Which means the step that ends people cannot live here, in the building. The buy took 90 seconds, which is exactly why the difficulty must live somewhere else. Take two beginners who make the exact same choices. Same $1,000, same broad market fund, same 30 years, same drawdowns weathered without flinching. The only difference between them is a signature on an advisory agreement. One hired a professional at the industry standard 1% a year. The other did not. Follow them across 3 decades, and the gap that opens is not an opinion. It is arithmetic, and it is larger than most people are prepared to believe. Start at year 1. Both accounts hold $1,000. The do-it-yourself investor pays roughly $4 a year to own the fund, the near-zero cost floor established earlier. The advised investor pays that same $4 plus 1% of the balance to the advisor, $10 in year 1. $10 against $1,000. At this point, the two accounts are indistinguishable. Nobody looking at year 1 would call this a decision worth agonizing over. That is the trap, and it is the same trap the fee block already named. The charge is invisible precisely when it is small. Now let the timeline run. Both funds grow at the market's long-run average of about 10%. But the advised account grows at 9%, because 1 percentage point is handed off every year to the person managing it. Year by year, the fee is not $10. It is 1% of a balance that keeps getting larger, so the toll rises exactly as the account succeeds. The better the market does, the more the fee extracts, because it is charged on the whole compounding sum rather than on the original deposit. The turning point arrives quietly, somewhere around the second decade. The do-it-yourself account, compounding at 10%, pulls decisively ahead. Not because the funds differ, but because the missing percentage point has been reinvesting for the DIY investor and disappearing for the other. Every dollar the advisor took is a dollar that would have grown and would have grown into more. By year 30, the untouched 1,000 has become roughly 17,000. The advised version, dragged by that same 1%, lands closer to $4,000 on a single $1,000 deposit that neither investor ever added to. That is the consequence of 1%, and it answers the question this act left open. A lifetime advisory fee can quietly consume a sum larger than 4 times the amount originally invested. Not to a crash, not to a bad pick, to a number that felt too small to question. And this is the version that flatters the advisor because it assumes a single deposit. Layer on the automatic contributions from the automation block, steady money flowing in for decades, and the 1% drag compounds against a rising balance the entire way. The lifetime gap stops being 4,000 and climbs into 5 figures, sometimes well beyond, all of it extracted by a fee small enough that the investor was told, correctly, that $10 was nothing to worry about. None of this means an advisor is worthless. It means the one function beginners assume they are buying, fund selection, is the function the index already performed for free. The account setup, the fund choice, the cost floor, all of it is now assembled, at a desk, in calm, for almost nothing. So the portfolio is built, and the fee that would have leaked it is closed off. The buy was 90 seconds. The cost is a few dollars a year. By every measure on the page, this money should now be safe. But it isn't. The leak that ends most beginners hasn't appeared yet, because it was never in the building. A gym membership bought in January is a fine example of how humans handle intentions. The sign-up takes 10 minutes in a burst of resolve. The showing up every week, for years, when it is cold and dark and nothing feels urgent, is where almost everyone quietly quits. The decision was never the problem. The repetition was. Investing $1,000 has the identical shape, and it is worth staring at directly. The buy took 90 seconds. The hard part was never the buy. It is every month afterward, when the beginner is supposed to keep feeding the account and feels no reward for doing so, because compounding produces nothing visible in month 3 or month 8 or month 14. The resolve that carried them through the setup does not renew itself. It decays. And a portfolio that depends on a human choosing month after month to log in and move money is a portfolio built on a fuel that runs out. Here is the insight that quietly separates the investors who last from the ones who don't. The solution is not more discipline, it is less deciding. An automatic contribution, a fixed sum pulled from the checking account on the same day every month and deposited straight into the fund, removes the monthly decision entirely. There is no January resolve to sustain because there is no showing up to remember. The money moves whether the investor feels motivated or bored, or has forgotten the account exists. $50 a month or $100, on a schedule the investor set once and never has to reaffirm. The willpower is spent a single time, at setup, and then never again, asked for. This is not a productivity tip, it is a documented behavioral mechanism. Researchers studying retirement plans found that when saving is made the default, when contributions happen automatically unless the worker opts out, participation rates jump dramatically compared with plans requiring workers to actively sign up. The landmark studies on automatic enrollment showed participation climbing from roughly half of eligible workers to well over 90%, with the largest gains among exactly the people least likely to start on their own. Nothing about the workers changed, only the direction of the default changed. Inertia, which normally keeps people out of the market, was turned around to keep them in it. That is the whole trick, and it is more powerful than any amount of motivation. Human inertia is not a bug to overcome, it is a force to redirect. Left alone, inertia keeps money sitting in checking, uninvested, decaying to inflation. Pointed the other way by an automatic transfer, that same inertia keeps money flowing into the fund on its own, and the investor would have to take deliberate action to stop it. The path of least resistance, which used to lead nowhere, now leads into the market by default. And this is precisely where the earlier question closes. The buy was simple, almost embarrassingly so. So where does the money actually leak? One answer was the fee, silent, compounding, already sealed off. The other answer is the human, month after month, deciding whether to keep going and eventually deciding not to. Automation seals that leak too. It takes the least reliable component in the entire system, the beginner's sustained attention, and removes it from the machine altogether. The system no longer needs the person to be consistent, it only needs them to have set it up once. Consider what has now been assembled. Buffer, debt cleared, the right account, the near-zero cost fund, the 90-second buy, and now an engine that funds itself without asking anything further. On paper, the machine is complete, it runs itself, and it does, flawlessly through every ordinary month. But automation is a schedule, not a nerve. It handles the boring months without effort. It does nothing at all for the month the market falls 20%. The automation runs perfectly through the boring months. Then comes the one it was never built for. Return to the Denver archetype. 34, the buffer built, the Roth open, the near-zero cost total market fund bought in 90 seconds, $50 flowing in automatically on the first of every month. For 14 months, the system does exactly what it promised. She barely looks at it. The balance drifts up, and on the rare evening she checks, the number is a little higher than the last time. She has started to believe the thing works. That belief is about to be tested by the only exam that matters. In the 15th month, the market falls, not gently. Over 5 weeks, a broad index drops 22%, the kind of move that fills every headline she passes and every conversation she overhears. Her balance, contributions and all, was near $1,600. Now it reads $1,240. She did nothing wrong and lost $360 anyway. Watch what happens inside her, because the machine cannot see it and cannot stop it. The automation fires on schedule and buys more shares at the lower price, mechanically the best thing that could happen, and it brings her no comfort at all. What she feels is not spreadsheet logic. It is the 11 o'clock feeling named in the second block, arriving exactly on time. The number keeps sliding. Every instinct she owns reframes the situation. Holding now feels like stubbornness, like watching money burn out of pride. Selling feels like maturity. Like cutting a loss before it deepens. Like the responsible adult finally taking control of a mistake. This is the emotional core of the entire failure, and it is worth naming precisely. The fear does not feel like fear, it disguises itself as prudence. The urge to sell does not arrive wearing panic. It arrives wearing the calm voice of good judgment, telling her that a person who ignores a falling market is a fool, and a person who acts is wise. Every step before this one, the buffer, the account, the fund, the automation, she executed at a desk, in daylight, with time to compare. This decision is being made at night, in fear, with real money moving the wrong way in real time. She trained for every part of the process except the only part that decides the outcome. Here is the turn, and it is not the turn most guides offer. The comfortable ending would say, she remembers her research, she breathes, she holds, willpower wins. That ending is a lie, and the historical record exposes it. In every major decline of the past century, 1987, 2000, 2008, 2020, the investors who sold near the bottom were not unusually weak people. They were ordinary people whose willpower did exactly what willpower does under sustained fear. It bent. The studies on the gap between fund returns and investor returns measure the wreckage of that bending, decade after decade. Telling a frightened beginner to simply be stronger is telling a drowning person to breathe harder. So the turn is this. If willpower fails here reliably, if the calmest, best-prepared beginner still reaches 11 o'clock and feels prudence whispering the wrong instruction, then the defense cannot be willpower. It cannot be a feeling she summons in the moment the feeling is already compromised. A system that depends on the investor being brave at the exact moment fear is engineered to feel like wisdom is a system with no defense at all. Everything assembled so far handled the easy months, the buffer, the account, the fund, the automation. All of it runs on daylight logic. None of it answers the question standing in the room right now. When the account is down and every instinct says sell, what actually stops her from doing it? Not courage. Courage is exactly what has already left. October 19, 1987. In a single trading day, the US stock market lost 22% of its value, the largest one-day percentage drop in its history, larger than any single day of the 1929 crash. There was no war, no bank collapse, no headline that fully explained it. Prices simply fell off a cliff, and by the closing bell, a fortune had evaporated from every account holding stocks. Now follow two paths out of that day, because they are the only two that exist, and history keeps a scoreboard on both. The first path belongs to the seller. Watching the number collapse, the seller does the thing that feels like survival. They sell into the decline, converting a paper loss into a permanent one, and then they stay out, because the market that just punished them feels like a place no sane person returns to. That single decision has a name in the record: locking in. The loss stops being temporary the moment the shares are gone. The second path belongs to the holder. The holder does nothing. It does not feel like wisdom. It feels like paralysis, like being too frightened to act. And here is the consequence the timeline delivers. The market that fell 22% on that October Monday finished the very same year higher than it started, not a decade later, that same calendar year. The holder's loss was never real. It was a number on a screen that reversed itself within months. The seller's loss was the only permanent thing in the entire episode, and the seller created it themselves by acting. This is the pattern that repeats, and it is worth naming across the record rather than trusting to a single date. In 2000, the market began a long decline that erased trillions. The investors who sold near the bottom locked in the loss. The ones who held recovered and moved past their old highs. In 2008, the broad index fell by more than half from its peak, the kind of drop that ends careers and empties retirement dreams in headlines. Those who sold in early 2009 sold within weeks of the exact bottom, converting a terrifying paper loss into a real one right before the longest bull market in modern history began without them. In March 2020, the market fell roughly a third in about a month, faster than any crash before it. The sellers captured the loss. The holders were whole again inside the same year. 4 crashes, 4 different causes, 1 identical verdict. The decline was never what did the damage, the selling was. Notice what this inverts: the frightened beginner's entire instinct. Falling prices do not take money from a diversified holder. They cannot, unless the holder ratifies the loss by selling. The market takes money from exactly one kind of participant, the one who converts a temporary number into a permanent transaction. The drawdown is a threat only to the person who acts on it. To the person who does nothing, the drawdown is, historically, a discount, the automation buying more shares cheaply, exactly as it did for the archetype in the previous month. The record answers the fear with something the fear cannot argue with. The Denver archetype staring at 1240 at 11 o'clock is not looking at a loss. She is looking at 1987, at 2008, at 2020, at a number that has reversed itself every time a diversified holder refused to move. History is on the side of doing nothing. But history has a defect, and it is fatal at exactly this moment. History rhymes. Memory does not hold under fear. Knowing that every past crash reverse does nothing for the person whose own account is bleeding tonight, because in the grip of the 11 o'clock feeling, the past feels irrelevant, and this time feels different. Every seller in every crash also knew, abstractly, that markets recover. It did not stop them. Which means the defense cannot be knowledge either. Knowledge, like courage, deserts the room precisely when the market falls. Something outside the mind is needed. Something fixed before the fear arrives, that speaks in the investor's own calm voice, at the exact moment their frightened voice takes over. Something written. A pilot in an emergency does not improvise. The aircraft is falling, the instruments are screaming, and the last thing anyone wants is a professional inventing procedure in real time, so professionals don't. They reach for a checklist written in a quiet room months earlier by people who knew that the moment of crisis is exactly the moment judgment cannot be trusted. The written procedure is not a crutch for the weak. It is the standard tool of the competent, precisely because it was authored before the panic arrived. The frightened investor at 11 o'clock needs the same thing, and for the same reason, not more courage, not fresh knowledge. A rule written down in daylight, by the calm version of themselves, that the panicked version is bound to obey. Watch what happens without it. Return to the Denver archetype, staring at 1240. She knows, abstractly, that markets recover. She read it. She believes it on a normal Tuesday. But belief is not a plan, and at 11 o'clock the belief is negotiable. The frightened voice reframes everything, and there is nothing fixed to push back against. So she debates. And debating in that state is already losing. Because the debate is being refereed by fear, knowledge floats. It can be reinterpreted, discounted, waved away by a single headline. That is the counterexample. The investor, armed with every historical fact and no written commitment, sells anyway, because facts in the mind bend under pressure, and she had nothing outside her mind to hold the line. Now give her the rule. Before a single dollar was invested, in the same calm afternoon she opened the account. She wrote one sentence and saved it where she would see it. I will not sell during a decline. I will not check the balance more than once a month. My automatic contribution continues no matter what the market does. 3 clauses, no prediction. No forecast about where prices go. Just a pre-commitment about what she will and will not do, made by the only version of her qualified to make it, the one not currently afraid. Here is why this works when willpower and knowledge both fail. The rule was authored in daylight, and it speaks in daylight's voice. When the 11 o'clock feeling arrives disguised as prudence, she is no longer asked to out-argue it in the moment. The argument was already settled in advance by someone she trusts more than her frightened self. Herself, thinking clearly. The written rule converts the decision from a live judgment call, made under fire, into a decision already made, merely to be honored. She does not have to be brave. She only has to keep a promise. And this is the function nobody sells a course on, because it is the real thing an advisor was ever worth. Strip away the fund selection the index already handled for free. What remains, the part clients genuinely pay for, is a steady voice on the phone in March 2020 saying, do not sell. This is what we planned for, hold. The written rule is that voice, reproduced by the beginner, for free, and available at 11 o'clock when no advisor answers. It is not a lesser substitute. It is the same mechanism, delivered by the same principle, a commitment fixed before the fear that survives contact with it. That is what stops her from selling. Not resolve summoned in the moment. Resolve has already deserted, a sentence written before the moment ever came. The system is now complete on paper. Buffer, debt cleared, the right account, the near zero cost floor, one broad fund, an engine that funds itself, and a written rule that holds the whole thing steady when the market falls. Every leak named and sealed, every failure point defended in the order it arrives. One question remains, and it is the only one the paper cannot answer. Does the machine hold when a real market drop tests it? Not on the page, but in the account, with real money and a real person watching? Run the whole machine forward once, under fire, because the only test that ever counted is the one no diagram can pass for you. Month 15. The Denver archetype is down to 1240. The market has fallen 22% in 5 weeks, and the 11 o'clock feeling arrives exactly on schedule, wearing its usual disguise as good judgment. This is the moment the entire sequence was built for, not the buy, this. She opens the account, she sees the number, and then she does something that looks, from the outside, like nothing at all. She does not sell. She reads the sentence she wrote in daylight, months earlier, back when she was calm enough to be trusted. I will not sell during a decline. She closes the app. The automatic contribution fires on the first of the month, and buys more shares at the lower price, and she does not stop it, because stopping it would require a deliberate act she has already pre-committed not to take. The buffer she built in the very first prerequisite sits untouched in a boring savings account, absorbing the ordinary emergency that arrives that same quarter, the cracked tooth, the reduced hours, so that not one invested dollar is sold to cover it. Trace what just held. The buffer meant she wasn't forced to sell. The account meant the recovery would compound untaxed. The near zero cost floor meant no silent fee was bleeding her while she waited. The one broad fund meant she owned the whole market's eventual rebound, not a single bet that might not return. The automation meant she didn't have to summon motivation in the worst month of the year. And the written rule meant she didn't have to be brave at 11 o'clock, when Bravery had already left the room. Each piece defended the moment the next piece couldn't reach. Remove any one, and the machine tilts toward the sale. By the following year, the number has reversed. 1240 becomes 1600 again, then more. The shares her automation bought at the bottom, now the most valuable ones she owns. She did not outpredict the market. She did not out-argue her own fear. She simply built a structure that made the panic sale the harder thing to do, and doing nothing the default. Now the loop this whole documentary opened on can finally close. If $1,000 is enough to start, why do most people who start with it end up back at zero within 2 years? Not because the 1,000 was too small. The arithmetic settled that in the first minute. Not because they picked the wrong fund. The fund was almost always fine. They end at zero because they built the sequence out of order, or skipped a piece, and arrived at the first drawdown with nothing outside their own frightened mind to hold the line. They sold. The compounding curve never got to exist. The failure was never financial. It was structural, and it was behavioral, and it lived at one predictable point almost everyone reaches. The person who survives is not braver or smarter. She just laid the load-bearing walls before she needed them, in the order that made each one possible. The $1,000 was never really the subject. It was the smallest amount large enough to teach the whole system, and the system is the sequence, not the purchase. Buffer, debt, account, cost, fund, automation, rule. In that order. The ticker was the least important decision on the entire list. The sequence was always the point, and it still holds. This is education, not personalized advice. Wealth is built to last.